The big news of the day, the RBI has maintained a status quo on rates as expected. It's kept the repo as well as the CRR unchanged. The stance, however, does remain accommodative. We've got Latha Venkatesh joining in with more details. Latha, how do you interpret today's policy announcement?
The most important takeaway from the monetary policy statement and the governor's press conference is that the space for rate cut has definitely reduced. While the official statement says that the RBI remains in an accommodative stance, it points out to so many problems in terms of further cuts. The first of them being that food prices shot up very smartly in April. Overall headline inflation was higher than expected in April. And services inflation throughout, that is the non-food, non-fuel inflation, throughout the period has remained sticky at 5%. Now there, the RBI refers to items like water charges, house rent, tuition fees, and auto and cab fares. Now, I don't see in the next few months anything happening to reduce water charges or rents or tuition fees or car and auto fares. So given that, if that position is going to remain sticky, I think that even with the monsoon, the space for rate cut in the RBI's mind appears limited. Unless it's an extraordinary fall in fuel prices and food prices, perhaps the space for a rate cut is reduced. That is the key takeaway, which is basically a reiteration of something which the market already smelled after the April inflation. That's the first takeaway. The second takeaway is the Reserve Bank will continue to provide enough liquidity. It is not any better or any less than the April statement. So the bond markets, that's why I found comfort in that 7.45 to 7.50 for the 10-year bond. On the third issue of NPAs, there was nothing more that was added except that the implementation of the MCLR will be reviewed. The fourth takeaway was on the FCNRB deposits, $30 billion, which will move out of India, out of the banking system in September. The Reserve Bank governor merely reiterated that the Reserve Bank will ensure that there aren't too many problems for the monetary system, but for the banks, they will have to work very hard to make their own adjustments. What we hear from bankers after all this is that they will really wait for this September-October period to be over so that they're very sure how much deposits is left with them at what cost. Probably the big falls in MCLR will happen, or lending rate will happen only thereafter. So that's the bottom line. The action for lowering of lending rates is not anymore going to come from the Reserve Bank. It is only going to come in the form of transmission from banks, and banks have more or less indicated to us that they will be more comfortable only after the September-October FCNRB deposit migration.
We expect that a strong monsoon, continued astute food management, as well as steady expansion in supply capacity, especially in services, could help offset these upward pressures. But given the uncertainties, the Reserve Bank will stay on hold. However, the stance of monetary policy remains accommodative, and we will monitor macroeconomic and financial developments for any further scope for policy action. Relative to our April stance, the data that came in surprised on the upside. I don't think there's any news about that. The inflation reading in April was higher than anybody in the markets or we expected. There are potential disinflationary pressures. There are also potential inflationary pressures. The net effect is we've put a little more weight on upside risk to inflation, but we have to wait and see. The target is obviously 5% by March 2017. That target is there for us to attain, and we have to figure out how to attain it.
Okay, so